Okay, so we look at Serenity, the 2014 service firm. I think this is the first one where they brought in a trade-in of a vehicle into it. It's pretty straightforward though. It's very, very similar to the 2017 DB Mach one. Um, anyway, as always, start with your capital, which is the what you own and owe at the start of the year. First thing, always check how many years depreciation there is. So it's 3 years depreciation. So first one we have is buildings and grounds. Um, so they start off at 620, less your accumulated depreciation, 3 years of that, which is the rate is 2%. So 2% is 620, and it's 3 years. So multiply your answer by 3, you get 37.2. Take them away from each other, 582,800. You've got your equipment. It starts off at 70,000. And your accumulated depreciation, the rate again is 3 years at 10% of 70,000, which is 21,000. So 70 minus 21 is 49,000. And then you've got your vehicles. Vehicles start off at 90,000. Depreciation is 20%. So 20% is 18,000 by 3 is 54,000. So you'll take that away and you get 36,000. Okay, so there are your three, which are depreciations involved. Next one then is your opening stock. So, or sorry, your stocks in the shop. And the stock in the shop is 3,400. Your stock of heating oil is an asset, and that's 1,900. Creditors for supplies are a liability. So creditors for supplies are 1,600. Your investments are 40,000. They're 5% investments, so just be aware of that when you're coming to your investment income later on. It'll be 5% of 40,000. Contract cleaning prepaid, that's an asset. Contract cleaning prepaid is 400. Clients' deposits paid in advance, so we owe them the money back or we owe them the service, it's a liability. 6,000. Authorized we do nothing with, and issued share capital is 450. So bank balance then is our next one. So bank balance is 6,000. So that's an asset because it's on the debit side. So on the credit would be a liability. Then we've got our loan. So it tells us the loan in this case. So the loan is 50,000, and then we have to work out the loan interest due. That'll be our first working. So we'll come down. Loan interest is 6,000, and it's for 15 months. The expense this year is 3 months. So you paid the loan back on the 1st of the 3rd, or 1st of the 4th, sorry, so it's 3 months. That means due on the 1st of the 1st is 12 months. So we'll divide that 15 or 6,000 by 15 and multiply it by 3 and multiply it by 12. So your loan interest due, your liability is 4,800. Okay, so I'm going to put that 1,200 straight away into my expenditure. the benefit of having it all written out so as I don't forget about it later. Okay, so that should be there's nothing else there. So that should be our statement of capital done. Oh, sorry. What the hell is going on here? Ah. So I managed to move into a different thing there, into a previous question. So anyway, just add up your assets. They add up to 719,500. Add up your liabilities, 512,400, and take them away, and that's your reserves on the first of the first. Sure, you call it that. So you lose out on a mark. Okay, that's part one done. Part two is our shop trading account. So nice and straightforward. Sales is 45,000. Now you should check to make sure there's no shop debtors in the question. We saw that in one of the other mock questions. There's no reason why it couldn't be in it. There was no shop debtors at the top, or else I would have seen it. There's not at the bottom, so we can just put them in. Your cost of sales then, your opening stock is 3,400. Shop purchases is 28,000. And the closing stock at the bottom for the shop is 1,400. So that should be, what's that, 26,000 or 30,000, sorry. So we'll take that away to get a initial shop profit of 15,000. Down to working 4 to find the rest of our shop expenses. So we've got wages and salaries. Wages and salaries, 22,000. Include 22,000 paid to the secretary who also runs the shop, and 40% of that salary is for the shop. So 40% of 22,000 is 88. It's 400 of the light heat, 800 of the insurance, and 500 of the telephone. Are attributable to the shop. So we'll just add those up, take them away, and that gives us our shop profit of 4,500. Okay, now I'm also going to put in these wages and salaries and so on into my expenses. So minus 88. Light and heat is minus 400. And again, these are just reminders to split these expenses up when we get to them. Insurance minus 800. And the last one is 500 for the telephone. Okay, so that's our shop trading profit and loss account done, and we've got ourselves set up for our income and expenditure calculator. Okay, so you're onto your trading profit and loss account and balance sheet. And what we need to do for those is start back up at the top. The first things we're going to do are our fixed assets. So we've got our 3 fixed assets. We know we have them: buildings, equipment, and vehicles. And we've got our information on our depreciation here. So anyway, building starts at 620. Always check to the side. You've got an extension of 230. So 620 plus the 230 is 850. And pretty much with buildings in all of the questions, they've revalued them. So they've revalued the buildings to 900,000. So we'll just put in our cost at 900,000. We'll do our depreciation working then. So it's 2%. It's not of the revalued amount, it's 2% of the 850. So 620 plus the 230. So that's 17,000, and that's your expense. So the 17,000 is going into your expenses. Now, every time we've got depreciation, we'll either have accumulated depreciation, or in this case, revaluation reserve. So the revaluation reserve is basically your accumulated depreciation. So you start with your initial starting figure for your accumulated depreciation, which was 37.2. Where am I gone? It's over here, isn't it? Start with your 37.2. That's from part one. Add on your depreciation that we've just worked out, and then that will give you your accumulated depreciation of, what would that be, 54,000. You then have to add on your revaluation surplus. So your buildings have gone from 850, 620 and 230, so 850 up to 900,000. So there's an extra 50,000 there. So that gives you your revaluation reserve of 104,200. Okay, and we're going to put that into our finance buy. I'll just put in my share capital now. That's the 600 and the 450. So we've got a revaluation reserve of the 104,200. Okay, that's the first one done. The second one is the vehicles. So the vehicles of costs were 90,000. Sorry, the second one was equipment. So equipment was 70,000. You bought new equipment costing 15. There's no sale of equipment, so it's just straightforward enough. The depreciation on the equipment is 10% of the 70, and the new equipment costing 15. So it's 10% of 85,000, which will be 8,500. Your accumulated depreciation then is what you started off with in part one in your statement of reserves. So this 21,000, add on the 8.5, and that'll give you your accumulated depreciation of the 29,500. So I'm going to put that 8,500 in my depreciation of equipment. This is always the smallest number of the three of them. So that'll be what I said was 8.5. Then I'll put my equipment 85,000, and then I'll put my accumulated depreciation, which is 29.5. And obviously take them away. That's 55.5. The vehicles then, so this is nearly like our question one vehicles working. So it tells us the vehicles are 70,000. There's a new vehicle that we paid 50,000 cash for. That doesn't mean it cost 50,000. It means we paid 50,000 for it. And then down at the bottom it says vehicles 20% of cost from the date of purchase to the date of sale. So on the 1st of the 7th, a vehicle which cost 40 was traded in against a new vehicle costing 59. So our first thing is to work out what our vehicles are now. So vehicles started off at 90,000 minus the 40 plus the 59. Will be 109,000. That's our vehicles at cost. Okay, so I'm going to put that in up here. So Then we have our depreciation. So just like our question one, the rate of depreciation of vehicles is 20%. So for the first part of the year, we had 90,000. So 20% of 90,000 for the first 6 months of the year, which is 9,000 euros. For the remaining 6 months of the year, we had 109,000, which would be 10,900. So in total, we've got depreciation, our expense is 19,900. And that's what's going into our trading profit and loss account. So the 19,900. Okay, and as always, anytime we have depreciation, we've accumulated depreciation. So our accumulated depreciation started off as 21,000. Always back to your reserves to find that. Add on your 19,900. Then we have to take away the depreciation on the van we sold. So that's 20% of it. It cost us 40,000, and we had it for how many months? So we got it for on the first of the first 2010. So we had it for all of 10, 11, and 12. So three years. So that's 36 months. Then we had it for another 6 months in 2013 up to the 1st of July. So till the end of June. So 36 plus 6 is 42. So that will be 28,000 depreciation that we no longer have. So our accumulated depreciation is 21,000 plus 99 minus 28,000, which is 12,900. Okay, so into our balance sheet, that can't be right. Sorry, I may have taken the wrong figure there from vehicles. So vehicles is 54,000. So that should have started at 54,000. Apologies, I took the equipment one. So that'll be 45,900 into your accumulated depreciation. Okay, so we'll just take that away. That gives you 63,100. Okay, so that's your fixed assets done. From here now, we're just making changes to our expenses. And remember our accruals concept, we account for stuff when it happens, not when it's paid for. So if there's anything due at the start of the year, it means it's from last year, so you take it away. It's not for this year's accounts. If there's anything due at the end of the year, it has to be paid for, but it is for this year's accounts with add on. The opposite for prepaids. If there's something prepaid at the start of the year, it has to get added on. Paid for last year, but for this year's accounts, prepaid at the end of the year gets taken away. Creditors at the start of the year are the same as dues. So creditors and debtors are dues. So they get taken away at the start and added at the end. And then opening stocks are like prepaids. So add them on at the start of the year, take away closing stocks at the end of the year. There are rules. So we get to our shop in stock. That's ticked off, done with. Again, remember to tick off equipment, new extension, new vehicle, and loan. They're all done with as well. And your opening bank balance. Um, so stock of heating oil is our first one. So stock of heating oil is to do with light and heat. So we're always going to start with our light and heat figure from the expenses. So we'll take our light and heat from the expenses. We've got in this case 3,400. We're going to add on our stock of oil at the start, which is 1,900. And we're going to take away our stock of oil at the end of the year, which is 600. Now from that point, we're going to see if there's any light and heat due. And you'll see that there's none at the start. There's no mention of light and heat due, but there is a light and heat due of 360 at the end. Okay, so we're going to add that on. Okay, so our light and heat expense then is 5060. Okay, so light and heat 5060 into our expenditure. And we note that there's a 400 to be taken away that's already in the shop, and that's 4660. So that's all our light and heat's done. Tick them all off, they're dealt with. Creditors for supplies to the gym. That's going to tie in with purchases of supplies. So purchases of supplies starts off at 35.4. A creditor at the start of the year means we haven't paid them yet, uh, but we are going to have to pay them at some stage. So they're for last year. So included in this 35.4 would have been this payment for last year of 1,600 to take away. However, if there's creditors at the end of the year, it's stuff we've bought this year for use this year but hasn't been paid for. So we have to add that on. So we're going to add that 2.5 at the bottom. So that's 36,300. Okay, so that is our expense. So purchases of supplies, 36,300 into our expenditure. 36.3. Okay, now 5% investments, they're an asset. So come down here. We've got our 5% investments, which are 40,000. So anytime we've got investments, we have investment income as well. So in our income, it's that 5% of 40,000. Doesn't matter that there's investment income received here or anything like that for the time being. Anytime it gives you a percentage, we use that percentage. So we find 5% of the 40,000, and that'll be 2,000 euros. Anytime we've got investment income, we should have investment income due in our current assets. So over to our current assets, we've got investment income due, which is 2,000 minus 1,200. So the amount we're going to receive, 2,000 minus the amount we did receive of 1,200, which gives us investment income due of 800. And that's that ticked off, dealt with. Okay, so that's our investments. Last couple, contract cleaning prepaid. So go and find our contract cleaning to start off with of 3.6. Prepaid at the start of the year, so paid last year for this year, so add it on. And then there should be a prepaid at the end of the year as well. So cleaning is done under contract, payable monthly in advance, and includes a payment of 500 for January. So I'm going to take away that 500 and you'll get 3,500 as your expense. Okay, so your cleaning is 3.5, and that can go in as your expense. Okay, nearly coming to the end of these. Clients deposits in advance 6,000. So that's people who've paid us last year for this year, so it gets added on to our clients' fees. So you've got 330,500. So it starts off at 330,500. Add on the money we've received last year for this year of 6,000. If anybody's paid us at the end of the year for next year, which they have, 6.5, that's for next year, so it gets taken away. But it also tells us we've clients fees due of 800. So clients have used our service this year but haven't paid us. They'll probably pay us next year, but it has to be added in. So your clients fees then become 330,800. Sorry. So we will finish off the question then by going through the rest of these things and making sure we've got them in. So hopefully this bank balance we've ticked off, that's doesn't get used. It's from the first to the first. It's only used in our statement of reserves. Clients fees to tick off, that's done. Investment income, that was ticked off. Shop receipts, that's ticked off. Next one is our balance at the end of the year. So our balance is on the debit side here above the lines. That means payments were greater than receipts. So it's a current liability. So our bank balance of 135,000 is a current liability. If it was on the other side, it would mean that receipts were greater than payments, so you'd have money in the bank, so it would be a current asset. Okay, laundry is next, 2.5. There's nothing at the bottom about laundry, so it can go straight in. So I don't have any laundry, so 2.5. Telephone 1600, that's in there already. So we take the 1600 and we're going to take away the 800 that's already in the shop. Wages and salaries 85.4. We'll take the 85.4 and we're going to take away the 88. And that's 76.6. So the 88, that was the secretary's wages in the shop. So we'll keep going then. The loan should be ticked off. The equipment is ticked off. The new extension, the new vehicles, contract cleaning, light and heat. Insurance. So I've put that in the wrong one. Sorry. Telephone was 1100. 1600 minus 500. Insurance is 68 minus 800, which is 6,000. So that should be them all. I'm just going to get everything in at the bottom and make sure there was no errors along the way. So all of this stuff from the bottom, with the exception of number 4, have to go in our balance sheet somewhere. So they all have gone in our income and expenditure. They now also have to go into our balance sheet. So looking at our balance sheet, we've got our 2 closing stocks. So we've our shop stock at the end of the year, which is 1400, and we've our stock of oil, which is 600. We've got our cleaning prepaid. So cleaning prepaid, we've paid that in advance. So that's money or cleaning services that are owed back to us. So the cleaning prepaid is 500. Number 4, so that's just a movement. That's just an indication of movements of some of the expenses into the shop. So none of those go in the balance sheet. But the creditors for supplies to the gym do. So the creditors are 2.5, and the electricity due is 360. That goes in. Our depreciations are in already. Our evaluation reserve is in already. So that should be everything. Okay, so hopefully it'll balance. I tend to make a few little input errors as we go, which we'll hopefully find if it doesn't balance. So they add up to 337,300. Okay, so our expenditures then add up to 177,260. Now, what have I left out there? Because I've got the answer beside me here. So wages 76,600. Insurance 6,000. Light and heat 4,660. Purchases and supplies 36,300. Loan interest 1,200. Laundry is 2.5. 3 depreciations then telephone 11, laundry 17, 85 and 99. The loss, oh yeah. Oh, sorry lads. Going back to this vehicle's working now. This is what I told you to be careful about in the last question that we did, and I didn't take note myself. Anytime we sell a fixed asset, we have to see if we made a profit or loss on the sale of that fixed asset. So you compare, so this is to do with the vehicles. So hopefully most of you spotted this when we were going through it. But anyway, if you didn't, grand. You compare the value of the vehicle. The value of the vehicle is what it's worth. So what the vehicle was worth when we sold was 40,000 minus its accumulated depreciation of 28,800. So its value was 11,200. You received an allowance of, sorry, 28. So that's 12,000. You received an allowance of 9,000. So we got 9,000 for something that was worth 12,000. So that's a loss on the sale of 3,000. That's the type of silly mistake now that when you're rushing stuff you make, just leaving that out. It's really important in every question that we do that if you buy or sorry, if you sell a fixed asset, that you see if there's a profit or loss on disposal. That 3,000, it's an expense. So we'll add up all of expenses now, and we get 180, 260. Just bear with me. I want to just have a quick check of the marking scheme on my phone. Yeah. So we're going to take them away to get a net profit of 157,040. Don't forget then, add on your reserves on the 1st of the 1st, and that's your answer from part 1. And that was 207,100. So we'll add that reserves on, and you get 364,140 as your reserves on the 31st of the 12th. So that's the number that's going into your balance sheet, 364,140. Or your profit and loss balance, 31st of the 12th, whatever you want to call it. So our assets, we'll add them up. So our fixed assets add up to 101,860. Add on your investments, and you're getting 105,860. Now, you can already tell I've left out one current asset and one current liability just from looking at them. I skipped the number 3 here, clients fees due and clients fees prepaid. So clients fees due to us were 800, and clients fees prepaid, I'll just have to put in an extra line here. Clients fees prepaid are 6,500. So again, that's the whole idea of just going through it line by line and making sure you get everything in. As you know, I'm desperate for leaving stuff out at the bottom just for rushing through the thing too quickly. But the more you practice these, the more you see the ones that you know you should always have. So that's 144, 360, and 41. So we're taking those away from each other to get our working capital. So obviously this service provider is overtrading by a good bit. They've a minus 142.60. So you're going to take away that 142.60 from the fixed assets. That'll give you your total net assets of 918,340. hopefully, when we add up our 3 and our finance by B2, we get 918, 340 as our capital employed. Okay, so quite only there are marks going for Part E, 6 marks going for it. So the owners of Serenity Gym have proposed a 50% increase in clients' fees to help clear the bank overdraft. What argument would you make against this proposal? So that's an economic argument. So the argument is, well, they've got a bank overdraft of 135,000 euros. Um, how much of an increase in fees will it bring in? So it'll bring in, you can work it out. It would bring in about 50,000. So you can work it out 15% of 330,000. Or sorry, of clients' fees is of 33800. We'll find 15% of that and see what we bring it in. That's going to be way less than the overdraft. So that's an argument against it. It actually wouldn't work to clear the bank overdraft. The next argument is, well, are they profitable? The answer is yes. They're making profits of 157,040 euros. So they're trading enough to actually clear the overdraft year on year out of their current resources. That would be another one. So the argument is that they could clear their overdraft from their profits over time. Um, Within one more year or within a couple of years, that overdraft will be cleared if they just use the reserves. The next thing is an economic argument is when you increase prices, demand for your services will fall. So there's no guarantee that the increase in prices would actually lead to an increase in their clients' revenues. Uh, the next thing is to say, well, where did that money come from, or why are they down so much? Well, they've some pretty significant once-off expenditure. They repaid a 50,000 loan. They built a new extension. They bought a new vehicle. They bought new equipment. You would have to think they're all once-off payments that are reducing their cash balance. So it's sort of an exceptional year that there's no need to panic on these things. If they'd bought these things with loans and paid for them over their useful economic life, well, then they wouldn't have had a bank overdraft in the first place. So you probably need 2 or 3 small points. First thing always is it's just the arguments against it. So they would clear the loan fairly quickly. The client fees could see if you increase the prices, it could have a negative knock-on effect. That they will work out their bank overdraft with their profit over time. All right. Uh, we'll talk to you again, lads.